We've looked at what bonds promise. We've looked at what they actually returned. Now we look at what they did at their absolute worst. Because if you're going to hold an asset for decades, if you're going to call it your seatbelt, you need to know exactly when that seatbelt failed. And it has failed, dramatically, more than once. February 1994, the Federal Reserve raises interest rates. Unexpected, aggressive. 7 hikes over 12 months. Long-dated Treasury bonds lose up to 15% of their value. The shockwave goes global. Bond markets in Europe, Mexico, and Asia take heavy hits. And then the headline that defined an era, Orange County, California, one of the wealthiest local governments in the United States, files for bankruptcy. Not a developing country, not a reckless corporation. A prosperous American county with a $1.7 billion loss on leveraged bond derivatives. The lesson: bonds held with leverage or without understanding duration risk aren't safe. They're a loaded weapon pointed at your portfolio. We actually did a full breakdown on Patreon of how to preserve your assets in times of uncertainty. If you want to know more about how to manage your finances and get serious in-depth analysis on economics and geopolitics, join us there, link in the description. Now, back to the crashes. May 2013, Fed Chairman Ben Bernanke gives congressional testimony. He doesn't raise rates. He doesn't announce anything final. He simply suggests that the Fed might at some point slow down its bond-buying program. That's all it takes. The 10-year Treasury yield rockets from 1.6% to nearly 3% in 5 months. Long-duration bond funds lose 15 to 20% without a single rate hike actually happening. Just the idea of normalizing monetary policy was enough to crater the safe asset. This is what bond investors mean when they talk about sentiment risk. You don't need a crisis, you don't need a default, you just need a hint from one person at one press conference. And then 2022, the year the myth died for an entire generation. Bank of America did the research, going back centuries of financial history across every major market event, every war, every depression. 2022 was the single worst year for bonds since 1788. The numbers stated plainly: Bloomberg US Aggregate Bond Index, 13%. German Bund Long Duration, 18%. US 30-year Treasury, 35%. iShares 20-plus year Treasury ETF, 31%. The Federal Reserve raised rates from 0.25% to 4.5% in under 12 months to fight post-COVID inflation. The same inflation bonds offered no protection against. Retirees who had shifted into safe portfolios lost a third of their savings. People who did everything right, diversified, de-risked, listened to their advisors, watched their capital evaporate. And the 60-40 portfolio, the Great Balancing Act, returned minus 16% in 2022. Stocks down, bonds down, at the same time. The seatbelt and the airbag failed simultaneously. Episode 4 closes the series. 5 structural flaws baked into bonds that no rate cycle can fix, and the question that launches the next series entirely: how to preserve your assets in times of high uncertainty. Subscribe to Curiosity Matters, the link is right below, and join a community of people who refuse to take financial conventional wisdom at face value. If you want to learn how to preserve your assets in times of uncertainty, that analysis is on our Patreon. In-depth, practical, every week. Link in the description. See you in the final episode of this series.